Preparing for investment management at Fiera Capital interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work at Fiera Capital? I am attracted to Fiera Capital because it combines the resources of a global asset manager with an entrepreneurial, investment-led culture. Its capabilities across public and private markets would let me learn how different strategies serve institutional, intermediary, and private wealth clients. I also value the firm's emphasis on long-term partnerships and responsible investment. This role fits my strengths in analysis, communication, and disciplined execution, while offering a strong platform to develop as an investment professional. While answering, focus on Fiera Capital's independent ownership, global investment platform, public and private markets capabilities, client-centric culture, and how the role aligns with your technical interests and long-term career goals. Question 2. What do you know about Fiera Capital? Fiera Capital is an independent global asset management firm serving institutional investors, financial intermediaries, and private wealth clients. Its platform spans traditional public market strategies, alternative investments, and private markets, including infrastructure, real estate, and private credit. The firm differentiates itself through specialist investment teams, a global reach, and a relationship-oriented approach. I would also highlight its commitment to responsible investment and innovation, because both influence how modern clients evaluate managers and portfolios. Make sure to cover Fiera Capital's role as an independent global asset manager, its broad investment capabilities, international presence, client segments, and emphasis on partnership, innovation, and responsible investing. Question 3. Walk me through your investment process. I begin by understanding the client mandate, benchmark, liquidity needs, and risk tolerance. Then I generate ideas, conduct fundamental and quantitative research, and form an investment thesis with explicit catalysts and downside risks. I assess valuation using appropriate metrics, size the position according to conviction and risk, and document the assumptions. After investing, I monitor operating results, market developments, and thesis changes. A disciplined sell framework is just as important as the initial purchase decision. In your answer, talk about defining the objective, researching securities or assets, forming a thesis, assessing valuation and risk, sizing the position, documenting assumptions, and monitoring performance against the original thesis. Question 4. How would you evaluate whether an investment is attractive? An attractive investment offers a favorable relationship between expected return and risk, not merely a low headline valuation. I would evaluate the quality and durability of the business, industry structure, management, growth prospects, cash flow generation, balance sheet, and valuation under multiple scenarios. I would then identify catalysts and downside risks, test liquidity, and determine whether the position improves the portfolio. Finally, I would compare the opportunity with alternatives available within the mandate. Be sure to mention business quality, competitive advantage, growth, profitability, balance sheet strength, valuation, catalysts, downside scenarios, liquidity, and fit with the portfolio's mandate and risk budget. Question 5. How do rising interest rates affect asset prices and portfolios? Rising rates generally reduce the present value of future cash flows, pressure long-duration bonds, and can compress equity valuation multiples. They also increase borrowing costs, potentially weakening highly leveraged companies, while financial institutions may benefit initially from wider lending margins. I would examine duration, refinancing needs, credit quality, and sector exposure rather than applying one blanket conclusion. Portfolio responses could include reducing rate sensitivity, emphasizing resilient cash flows, and maintaining liquidity for better opportunities. Focus on discount rates, bond duration, borrowing costs, equity valuation multiples, credit spreads, currency effects, sector sensitivity, and how active managers may adjust duration, quality, liquidity, and portfolio exposures. Question 6. Explain the difference between active and passive management. Passive management seeks to replicate a benchmark at low cost, so performance largely reflects index returns minus fees and tracking error. Active management deliberately differs from the benchmark to exploit mispricing, security selection, factor exposure, or risk management opportunities. It requires research and usually carries higher fees, and success depends on delivering value after costs. I would choose between them based on market efficiency, client objectives, liquidity, tax considerations, and the manager's demonstrated edge. Make sure to cover the objective, source of returns, fees, tracking error, benchmark dependence, research intensity, market efficiency, and situations where active or passive exposure may be more suitable. Question 7. How would you assess a company's financial health? I assess financial health through profitability, cash generation, balance sheet resilience, and the quality of reported earnings. I examine revenue growth and concentration, margins, operating cash flow, free cash flow conversion, leverage, interest coverage, liquidity, and working capital trends. I compare those measures with peers and historical performance, then investigate unusual accounting items or aggressive assumptions. Strong returns on capital and disciplined capital allocation are especially important because they indicate whether growth is creating economic value. In your answer, discuss revenue quality, margins, cash conversion, leverage, liquidity, return metrics, working capital, capital allocation, accounting quality, industry comparisons, and trends rather than relying on one ratio. Question 8. What is duration, and why does it matter in fixed income investing? Duration measures a bond's approximate sensitivity to changes in interest rates. As a rule of thumb, a bond with 5 years of duration may fall about 5% if yields rise 1 percentage point, before considering convexity and spread changes. Longer maturities and lower coupons usually create greater duration. I would use duration to manage portfolio rate exposure, but also examine yield curve positioning, credit spreads, reinvestment risk, and the client's investment horizon. Be sure to mention duration as interest rate sensitivity, the approximate price-yield relationship, maturity and coupon effects, curve positioning, convexity, and how duration influences portfolio risk management. Question 9. How do you distinguish alpha from beta? Beta represents returns earned from exposure to a market or systematic risk factor, while alpha is the excess return attributable to active decisions after accounting for relevant risks and costs. For example, an equity portfolio may outperform simply because it has more technology exposure, not because of superior security selection. I would use an appropriate benchmark and factor analysis to separate these effects, then evaluate whether the manager's alpha is consistent, explainable, and repeatable. Focus on beta as systematic market exposure, alpha as risk-adjusted excess return, benchmark selection, factor exposures, implementation costs, and the importance of evaluating performance across a complete market cycle. Question 10. Tell me about an investment recommendation you made. I recommended a high-quality industrial company trading below peers because temporary supply chain disruption obscured improving normalized margins. I built a forecast separating temporary costs from recurring expenses, compared valuation using earnings and cash flow multiples, and identified debt reduction as a catalyst. I presented the thesis alongside downside cases involving weaker demand and prolonged inflation. The recommendation was approved with a modest position size. The experience taught me to communicate uncertainty clearly and distinguish facts from assumptions. Make sure to explain the initial thesis, research performed, valuation, key risks, recommendation, your personal contribution, outcome, and what you learned, without overstating certainty or claiming responsibility for team decisions. Question 11. How would you build a portfolio for a conservative institutional client? I would begin with the institution's liabilities, spending needs, liquidity requirements, time horizon, and acceptable drawdown. A conservative portfolio might combine high-quality fixed income, diversified equities, cash reserves, and carefully selected diversifiers. I would control duration, credit, currency, and concentration risks, while ensuring each allocation has a clear role. Before implementation, I would stress test inflation, recession, and rate shocks. Ongoing monitoring would compare results with objectives, liabilities, and the agreed risk budget. In your answer, cover liability awareness, capital preservation, liquidity, diversification, duration, credit quality, return objectives, downside tolerance, benchmarks, scenario analysis, and ongoing governance with the client. Question 12. What does responsible investment mean to you? Responsible investment means integrating financially material environmental, social, and governance factors into decisions while preserving fiduciary discipline. I would consider issues such as climate exposure, labor practices, governance quality, regulatory risk, and transition planning alongside valuation and cash flows. Depending on the mandate, tools may include engagement, proxy voting, exclusions, thematic investing, or portfolio targets. I would avoid treating ESG labels as conclusions. The analysis must be evidence-based, transparent, and connected to risk or return. Be sure to mention material environmental, social, and governance factors, fiduciary duty, engagement, voting, risk-return relevance, data limitations, documentation, and avoiding superficial sustainability claims. Question 13. How would you explain an investment strategy to a non-investment client? I would start with the client's objective, then explain the strategy in terms of what it owns, why those assets should create value, and what could cause losses. For example, instead of saying duration is high, I would explain that the portfolio is more sensitive to interest rate changes. I would use a simple example, discuss expected behavior in different markets, and clearly distinguish expectations from guarantees. Finally, I would invite questions and confirm that the explanation addressed the client's concern. Focus on starting with the client's objective, using plain language, explaining sources of return and risk, avoiding jargon, using a relevant example, checking understanding, and linking the strategy to portfolio outcomes. Question 14. What performance measures would you use to evaluate an asset manager? I would evaluate performance relative to an appropriate benchmark and peer group, but returns alone are insufficient. I would examine volatility, maximum drawdown, downside capture, Sharpe ratio, information ratio, tracking error, and performance attribution. I would also assess fees, capacity, turnover, liquidity, style consistency, and whether results came from intended exposures or unintended bets. Most importantly, I would review a full market cycle to determine whether the process produced repeatable, risk-adjusted value. Make sure to cover absolute and relative returns, benchmark appropriateness, risk-adjusted measures, drawdown, consistency, attribution, fees, capacity, style drift, and performance across different market environments. Question 15. How would you handle a portfolio position that has fallen sharply? I would not automatically sell or average down because of the price move. I would revisit the original thesis, update operating assumptions, assess whether the competitive position or balance sheet changed, and compare the current valuation with realistic scenarios. I would also check liquidity, concentration, mandate limits, and opportunity cost. If the thesis deteriorated, I would reduce or exit the position. If fundamentals remained intact, I might maintain or add selectively, with clear documentation. In your answer, discuss separating price movement from fundamental change, revisiting the thesis, checking liquidity and risk limits, avoiding emotional decisions, considering position size, and documenting the action taken. Question 16. Describe a time you found an error in financial or investment analysis. While reviewing a valuation model, I noticed that a debt balance had been included both in enterprise value and as a financing adjustment, overstating the implied equity value. I traced the formula, quantified the impact, and immediately informed the analyst and reviewer. We corrected the model, rechecked related outputs, and added a sign-off step for enterprise to equity bridges. The experience reinforced that independent review is essential, particularly when small formula errors can materially influence an investment recommendation. Be sure to explain how you identified the issue, quantified its impact, communicated promptly, corrected the work, prevented recurrence, and demonstrated accountability without blaming colleagues. Question 17. How do you prioritize competing deadlines in an asset management role? I prioritize work by client impact, market sensitivity, regulatory or control requirements, materiality, and dependencies. I break deliverables into milestones, confirm expectations with stakeholders, and reserve time for review before submission. If two urgent requests conflict, I communicate the trade-off early and propose a realistic sequence rather than allowing quality to suffer silently. I also use checklists for recurring processes, because speed is valuable only when the information remains accurate and properly controlled. Focus on client and market sensitivity, regulatory or control deadlines, dependencies, materiality, transparent communication, task tracking, quality control, and escalating conflicts early rather than silently compromising accuracy. Question 18. What would you do if an investment team disagreed with your analysis? I would first make sure I understood the team's assumptions and identify whether the disagreement concerned data, methodology, or judgment. I would present my analysis clearly, distinguish observable facts from estimates, and test the disputed assumptions through sensitivity or scenario analysis. If new evidence weakened my view, I would revise it. If disagreement remained, I would document both cases and support the agreed decision after the appropriate review, while continuing to monitor the key uncertainty. In your answer, mention listening first, clarifying assumptions, separating facts from judgments, testing scenarios, using evidence, remaining open to revision, and supporting the final decision once governance is complete. Question 19. How do liquidity and capacity affect portfolio construction? Liquidity affects both implementation and the ability to meet client obligations during stress. I would consider trading volume, bid-ask spreads, market impact, redemption terms, settlement periods, and the time required to monetize private assets. Capacity matters because a strategy can lose its edge as assets grow and trades become harder to execute. Position sizes should reflect liquidity under normal and stressed conditions, with buffers for withdrawals and disciplined escalation when limits approach. Make sure to cover trading volume, bid-ask spreads, market impact, redemption needs, position sizing, strategy capacity, private market lockups, stress scenarios, and the difference between reported and realizable liquidity. Question 20. What questions would you ask the Fiera Capital team at the end of the interview? I would ask how the team defines success in the first 6 and 12 months, how investment decisions are challenged, and which responsibilities this role would own directly. I would also ask how teams collaborate across public and private markets, how client feedback influences product development, and what skills distinguish high performers at Fiera Capital. Finally, I would ask about current strategic priorities and the investment environment the team believes will matter most over the next several years. Focus on the team's investment philosophy, role expectations, decision-making process, client base, collaboration across strategies, development opportunities, success measures, and current strategic priorities for the platform. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.